Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Sherman.
Welcome, everybody, to episode number 42 of the Sparta Market Outlook. I'm Felipe Elink Sherman, your host today, and I'm joined by June from Singapore. Hi, June. How are you?
Hi, doing well, thanks.
Also, Jorge from Madrid. Hi, Jorge. How's everything over there?
Hi, Felipe. All very good. Thank you.
And last but not least, our good friend John Coleman from the US. Hi, John.
Hey, Felipe. I think this might be the first truly global podcast we've ever done. We're covering US, Europe, and Asia all in one podcast. So
True. That's good. Yeah, we're global. I mean, we are the number one podcast in commodity trading. So, we need to be global, and we're demonstrating. We're putting our money where our mouth is, and having a global coverage. So a lot of things to discuss about. Oh, yeah. June, you wanted for me to talk about MPGC. So I was there in Bahrain this week. I don't know, what can I say about MPGC? So the first thing I would say is that the AG, there's a special vibe in the AG. When you go and travel to Singapore, to Europe and US, it's, you have the dynamics of a mature market, whereas in AG, everything is there. It's still building mode, so there's a sort of level of excitement of the potential of things to be and to be done, whether it's a lot of the smaller companies, but also the bigger companies that are trying to become trading behemoths, like the Aramcos, the ADNOCs, the KPCs of their world, so there's a certain level of excitement. The conversation is not just about Trump. It's about what can we do, in this environment? How can we gain market share? And it's not something you normally hear about, So that I would say that's the number one thing about it. Other than that, it was, the obvious macroeconomic discussions. And even in this podcast, we do everything we can not to only talk about Trump, but as you will see from today, he is omnipresent, hopefully not yet omnipowerful, but he is everywhere, but yeah, it's at least that's the thing, is that it's not just about the macro, but it's about what you can do to the market and how can you influence it and be gaining market share and all that. So that's I would say the main takeaway from that conference.
I have one big question for you. Is the heat wave really what they're saying? Is it really that hot?
It was actually fine. It was, it was below 40 degrees. It was, it was nice. It was actually quite nice. Yeah. And Bahrain is a lovely place. Not the typical place you go, but was strongly recommended. Yeah. So let's go and talk about the multiple things we have in the docket today. Starting with you, June. We're starting to see more barrels into the market from OPEC. Let's talk about OPEC a little bit. What can you tell us about that?
So OPEC Plus, they had a meeting on Wednesday, and the outcome was basically reaffirming the group-wide quota till the end of 2026 and establish a mechanism for setting the 2027 baselines. The more interesting meeting will be happening on May 31st, and that's amongst the 8 OPEC Plus members that had pledged the additional voluntary cuts. Likely, they will finalize the July output from the meeting. Market expectation is another production increase of 411 KBD, similar to the last 2 months. A lot of people are asking, would this official hike prove too much for the market? Are we going to see flat price tumbling again? Our own view is been a paper increase essentially. What matters more to the flat price is really the marginal export quantity into the market. The increase we are seeing is essentially making overproduction official. And at the same time, AG is going to burn more crude for power gen requirements. When we looked at the ADNOC onshore Melbourne crude oil export availability forecast reports, there's actually no significant change from the Jan forecast for the June and July export numbers compared to their May forecast. So it's as if, there's really no change actually in the production coming out as exports. And so markets seem to have priced this in for the eventuality of this announcement, and we don't expect very big movement on flat price when we come in on Monday, at least from this news.
Okay, so not everything priced in, you say, no? That's the main takeaway from this, is that, we're also already at quite low levels on a flat price basis. How much of this any potential additional should be compensated by less from the US maybe at some point. Maybe we can talk about that later on, John. But yeah, on the negative side, on the flat price, I think it's sort of already baked in. The other big news, so today, obviously, and this is where we go back to omnipresent Trump, is the fact that the US court has blocked all of these tariffs. I guess the main word is uncertainty. Here we go again, because from what I read, it affects the global kind of tariffs, but not necessarily the industry-specific ones, like the steel or whatever. But maybe, John, you want to tell us a bit more about that?
Yeah, so I think that's the real key word here is uncertainty. I think the news that came out late in the evening in the U.S. yesterday, where a international trade court in the U.S. struck down his tariffs as being basically overreaching his executive authority, was their determination on the law he was leading to justify them, an economic emergency powers law they determined was not sufficient for him to wield that sort of policy on the trade front that's typically reserved for Congress. So they've effectively nullified all the tariffs that came out of Liberation Day. That's the base tariffs that he's applying to all nations, retaliatory tariffs that are or have been currently on pause. But as you mentioned, one of the key notable outliers there is sectoral tariffs. So things like steel and aluminum are still very much status quo as to where those were prior to that court ruling. So what does this actually mean for anything? Well, uncertainty does rule the day because it's almost certain that Trump is going to push this as far as he can in the U.S. court system. In fact, overnight, the Trump administration already put in an appeal to the circuit court. That is the first appellate court level here in the U.S. Depending on how that court rules, it could end up in the Supreme Court, and to be decided, the executive authority to apply such tariffs globally like that will be the outcome from that. So still probably at least weeks, if not months, of this getting tied up in the courts. From what I've read, there are still modest mechanisms that Trump can use to still try to affect the same outcome, even if not through the same means, applying tariffs through other avenues, that is. So there's still much uncertainty to come. I think, from the commodity market perspective, this is not much different than where we were yesterday. There wasn't much impact specifically on energy movement into or out of the US for the most part, save China. So that fact has not changed. I think the bigger question is just the broader economic fallout from this. So companies were already planning around a tariff world, planning investments or delaying investments, laying off workers. The economy started to move in the direction of a heavily tariffed world in the US, and it's very difficult for businesses to just turn on a dime. So this uncertainty doesn't do anything to alleviate, headaches around business planning and investments going forward, and still could be an economic overhang, not only for the US, but even the ripple effects into the global economy. So I think while this is a major headline grabbing item, I think there's still a tremendous amount of uncertainty, and we could still end up in the exact same place we were at the end of the day. So I think a lot more to come here.
For sure. I mean, as we've discussed many times, most of these tariffs don't affect directly, except for LPG into China, but they don't really affect the short term on oil movements, if you want. It affects the potential long-term demand in case there's any kind of, let's say, contraction of the economy, or the uncertainty reduces capex investments or whatever it is. Have we seen, I don't know, I'm completely going off script here, but do you guys know if on the container ships, have we seen a decrease in transfers, volumes, etc., from China to US, or, that maybe is a sort of like a first leading indicator of what's going on? Do we know anything?
Yeah, yes, I don't have any hard data in front of me, but I can speak to that a little bit. I think we've seen some mixed data from ports. West Coast ports in the U.S. are the primary indicators, at least at the outset. Places like Los Angeles and Seattle, those have shown some, soft indications that container traffic surged leading into the tariff implementation and then has potentially fallen off on the back end. I think there are some alarmist headlines out there that say, a fleet of empty tankers or empty container ships is moving into the U.S. out of China, and, store shelves are going to be empty. I think that's probably a bit on the extreme end, but I think there is a non-zero effect of commercial traffic between Asia and the West Coast U.S. as, truck volumes out of these major port areas has declined. A rise in empty arrivals has also, shown. So over the next few months, we'll get some hard data in terms of how much is actually been affected, but I think there is sufficient evidence to say that we've seen modest impact in supply chains, altering just from the short time this policy's been in place.
Yeah, there was a piece of news at the end of April, beginning of May, that we talk about it in some market commentaries, that the drop during April, I don't know if it's compared to the previous month or seasonal levels, we will have to check, but there was a drop of around 30 to 40% in the cargoes going from China to US. Right now we have a new environment on the tariffs. We have seen a big drop, but I think with this we can have the idea that if the tariffs are very, very high, the impact is immediate in the cargo flows.
Fair enough. As a summary, big headline, not necessarily a big impact for our day-to-day, I would say. Not right now. It just creates more uncertainty, more noise. Okay, so let's just put this in the noise category for now. Russia, that's the last, let's say, geopolitical one. Obviously, once again, Trump is not satisfied with the progress in terms of the peace discussions and now threatening to increase tariffs to Russia. How much of that is a tactic? How much of that is a reality? What do we know about that?
All we know is he's definitely had a more hawkish tone on Russia on his social media accounts. He's considering new sanctions. My feel is maybe he's currently he might get more incensed with the block on his tariffs, such that he moves even more quicker on the sanctions, which he has more authority over. But just wanted to highlight some interesting trends in the market where we saw India importing Russian crudes using US sanctioned tankers. Last week, 1 million barrels of Sokol from Russia was delivered to an Indian refinery, of which half of that volume was loaded after 2 STS transfers, one involving a US sanctioned vessel. The other US sanctioned vessels have transferred cargoes of Sokol that will be due to deliver next month. India actually previously said US sanctioned vessels will not be allowed to discharge in that country, although they have also maintained that it only abides by UN restrictions. How they're going around this is if they have bought the cargo on DES basis, then perhaps the refineries can't be held accountable for how the crude is being transported. If we will need to see whether there will be further ratcheting up of Russian sanctions before India kind of backs away again from doing this delivery method.
Fair enough. So that gives us a little bit of a picture of the multiple tariffs, sanctions, etc. Moving on into the product demand or the demand side economics, if you want, and staying within the supply and demand environment. June, maybe you can update us on what you're seeing globally with regards to supply and demand updates and demand in general.
I would say jet is actually the star here. Europe's jet fuel demand is looking strong. We are now Europe flights, for example, is already now a 2% increase versus the pre-COVID 2019 year. And jet fuel is also 5% higher demand year on year. We even heard UK refineries switching to buy Saharan blend crude to produce more jet yield. On the US side, API data has shown a commercial crude draw, 4.2 million barrels, Cushing drew 0.3 million barrels, gasoline as well drew 0.5 million barrels. Only distillates had a gain of 1.3 million barrels, but that's also from a very low inventory position. So demand seems to be healthy everywhere. But I think I'm switching on supply now. Watch out on supply, because right now, strong refining margins, and that's been the case for maybe about 1.5-2 months. And unlike most years, this is driven primarily by fuel oil. So refiners will run max if they can. Fuel oil is begging to be converted. It's like a $4 to $5 per barrel positive crack against Dubai in the east. The rest of the products will get produced at the margin. Whether there's enough demand or not for it, it will still be produced based on the current margins. Gasoline, we know, is kind of good margins now with summer driving demand. Naphtha is needed in the many petchem plants in the east. Syngas oil now is where we saw the cracks are in actually contango, reflecting probably this scenario where gas oil is the vulnerable product. I diverge a little bit from this topic, and I want to just draw attention to the biggest buyer of raw materials in the world, China. They have announced a proposal to allow participants to post foreign exchange as collateral for yuan-denominated trades in the Shanghai Futures Exchange, or the SHFE. They are currently soliciting feedback on this proposal by June the 4th. So although China is the world's largest buyer of raw materials, benchmark pricing for these key commodities are usually set elsewhere. So the internationalization of the SHFE will allow China to have more direct influence over the price of their imported commodities, and also increase the yuan's appeal as an international currency to rival the USD.
Well, let's see that happens. It's something that obviously it's not just about having a stronger influence on the pricing, but also the yuan versus dollar kind of discussion, which has been, that's a very, very important transition, if you want, that I think will take a lot of many years, but it's part of that process. It's moving away from the dollar. I don't know if we're still there yet, but interesting. The other one that we need to talk about, maybe I don't know if it's in the docket for today, and if not next week, is at MPGC. Everyone was talking about fuel oil and how it's been extremely strong, and now you're talking about, even now, the positive crack versus Dubai, and there's more and more demand. It's something that apparently caught most people by surprise. Now, I don't want to put you in an awkward situation, but I know Hua is not in today, but is there anything we can add about fuel oil? As it seemed to be a question mark that people were wondering.
It's also a question mark to me, and that's why I was asking about the heat wave. Is it true or not? Because the only thing that seems to be fueling the fuel oil crack would be incremental power gen requirement. Bunkers, for example, is maybe marine fuel is a little bit supported, but to see the rise of where the fuel oil crack is right now, I can't remember. Is it a 10-year high or something like that? It's just beyond whatever we have seen historically. So we just couldn't figure out what other things is driving this, because the demand picture itself doesn't seem to show why do we need this super strong crack.
Well, but you're saying that even despite the crack, it's still fuel oil is begging to be converted.
Yeah. I mean, because the price is signaling something, and with this kind of cracks, obviously it will be a positive simple margin for refineries.
Let's see. I mean, well, maybe we need to bring Hua to the next conversation, next week, definitely. Moving on to physical markets. And June, staying with you, June, on crude, what can you tell us has been happening, and where do you think the market is going when it comes to physical crude?
Okay, I will just focus on the EFS side of it for now. The Brent Dubai EFS, interestingly, breached $2 per barrel. It hit a high of 220 on Tuesday, and when we wrote our market Asian snippet, we were already bearish from that level, and I think it's come down now to about 190 per barrel. What we are seeing is ARBs are closed essentially for all West of Suez crudes coming into the east, and we already talked extensively about the increased need for oil for summer burn. It's not just crude, it's fuel oil, and Dubai being the marker for the heavier barrels should be rallying compared to Brent. So the elephant in the room is the incremental OPEC exports, and we also discussed that. Is that really going to be a 411 KBD of incremental production that will be coming out as export into the market? We don't think so. And yet refining margins are so strong, all driven by the price signal from both the high sulfur fuel and the low sulfur fuel oil crack. So we believe that ARBs will need to reopen to feed the increased refinery run rates, and therefore Dubai should strengthen relative to Brent. So we don't think that the $2 per barrel is sustained, all things being equal.
And John, moving to you on the west of Suez, WTI-Brent spreads are looking ultra tight as well. What are you seeing? What is your interpretation, and what do you think is going to happen?
Yeah, it's a pretty interesting setup for WTI at the moment. You're right. The TI-Brent spread is just ultra narrow. I think it's the most narrow we've seen in years, where it's actually threatening to breach $3, which is something we haven't seen in quite some time. I mean, just to walk through the conditions that we're seeing on the physical side in our data. So, like Jude mentioned, WTI is completely unworkable into Asia because of the wide EFS spread. So it's in the camp of all Atlantic Basin light crudes. It's really not economic to flow east. It is looking marginally workable into Europe based on our pricing. A lot of that has to do with rallying DFLs, keeping North Sea crude pricing supported, making WTI somewhat workable in there. But, we've seen, in recent weeks, WTI has been very expensive relative to all other light crudes out there, and exports have been dragging as a result. But what you're seeing right now is just a moonshot on this Brent WTI spread. So I think there's some actual fundamental things to dig into on this, to talk about where this might go and some potential risks going into the summer here, because I think one very important thing to call out here is the U.S. is about to enter peak refining run season. It usually crests late June into July, but Memorial Day, which just passed this last week, kind of the unofficial start to refining crude run season in the U.S. Cushing, the physical pricing point for NYMEX WTI, is at the lowest level entering summer refining season that we've seen in quite some time. We could talk about the rationale behind that, what's driving that. You could argue the TMX effect is in play, but at the end of the day, we're very tight on crude in Cushing, entering the biggest crude run season that we've seen, or entering the biggest part of the crude run rate of the year. So when we think about what this means for time spreads, I'm actually a little surprised at how tame they are. I mean, I know WTI calendar spreads have been moving higher this week. Right now, they're sitting at about 70 cents, which is fairly steep backwardation. But when I went back into the history and looked at some data, what I found was in 2022 was a very similar setup to now in terms of supply in Cushing was ultra low, approaching threatening tank bottoms and entering summer crude run season. That was a very different market setup in that, if you recall, that was, peak supply scarcity, triple digit crude prices from the fallout of sanctions on Russia and concerns that there just simply wasn't going to be enough crude in the world. So you had triple digit crude prices versus today's very anemic $60 crude prices. But at very similar Cushing inventory levels in 2022, time spreads were blowing out $3, $4. Right now, at this same week in 2022, time spreads were already $2.50. And again, right now they're at 70 cents. So we're seeing a much less responsive market to what's happening in Cushing inventories relative to entering a very peak demand season. We took a little bit of a breakdown to try to understand what was happening there. And I think it kind of comes out cleanly in the trader positioning data, which says basically speculative trading has all but evaporated and producer hedging, producer selling into the backside of the curve is obviously not a lot of appetite to hedge at $60 crude prices. So I think it's understandable why the curve is a little bit flatter. But the important thing to understand here is you have zero supply buffer for U.S. mid-continent refiners here. And what we're also entering into is a typical time of year when wildfires break out in Western Canada. That typically shuts in a fair amount of production, and it's almost a pretty reliable thing that happens. It's almost becoming a seasonal production shut-in, how frequent wildfires are up there. So with time spreads so tame relatively at the moment, given where Cushing inventories are, one single wildfire outbreak in Western Canada could set time spreads aflame here because honestly, we've seen them be 2, 3, 4 times as high with similar fundamental setups 3 years ago. So we've got a bit of a tinderbox setup here for WTI where any supply gyrations north of Cushing could send the WTI curve into extreme volatility. So that's just one we're kind of highlighting to watch for there, given where we are on a fundamental basis entering summer here.
Very interesting. So, and on top of that, you were saying that it's still marginally open into Europe, or you were saying that as well. So we have a combo situation where the stock levels are extremely low. We're entering peak production season. We have this potential of wildfires. The Arbs are obviously completely shut to Asia, but still marginally open despite WTI and so narrow relative to Brent. So, at some point, something's got to give. Maybe the story is this whole dynamic of OPEC telling one story and the US telling a very different story. And let's not forget that throughout the first half of the year, we kept talking about WTI being open to Asia, being so cheap and all that, contributing slowly, but inevitably to this situation where we are right now. So what's the trade?
What is the trade? That's a good question. So the tricky bit here, like I said, the market does appear to be overpricing an optimistic outcome in terms of supply availability for U.S. mid-continent refiners this summer. So with time spreads being, 50, 60, 70 cents, that's in my mind, the market saying, I'm not worried about any supply shortages going into summer. This is with a backdrop of U.S. rig count falling because crude prices are not exactly screaming for producers to add production, and Cushing inventories at tank bottoms. So I think the trade is something around hedging calendar spread blowouts, because I think that's the most known unknown out there at this point, is that WTI time spreads are at extreme risk of asymmetric upside.
You, June, what's your trade? How do you express that positioning in the market, especially relative to what you told us before around OPEC and all that?
I'm still thinking the EFS, the Brent Dubai, has to narrow a bit. Probably a comfortable range is more like the $1.50 versus where we are today at $1.90. And we will, as long as we start to then see the West, not the WTI, but maybe, a West African barrel crude starting to open back to the east, that's where the EFS should be at.
Okay, let's see. So, if I summarize the whole story around crude, the headline that everyone is talking about is OPEC. As we're talking, I just got an email from Bloomberg, OPEC plus adding more volume, etc. But June, you're saying, that's already baked in. And actually, it's more the marginal barrel you need to look at. So that is not so much of a bearish story. And the physical market is telling us, whether it's in the US, whether it's in Europe and all that, hey, something's going on here. Let's not forget that the underlying mentality that everyone has right now, the sort of the story is crude is bearish. That is the underlying story throughout the year. And everyone is publishing like stock levels are just going to go through the roof. And, and if it's not this month, it's going to be next month. And here we are every week telling, well, doesn't seem to be the story yet. So something for the listeners to keep in mind, it's we're not necessarily being like completely disregarding the supply story and being completely bullish, but I just want to challenge this rhetoric. How many times as a trader everyone had the same story and everyone fell into the same herd mentality and I don't want to buy into a market, and then nothing happens and everyone falls into the same trap. So that's my takeaway from this conversation is, sometimes listen to other voices, and this one is a particularly interesting one. When everyone is talking about OPEC, you're talking about something else, and it makes a lot of sense. Jorge, moving on to light ends. We spoke last week and over the last 2-3 weeks about this discrepancy between gas naphtha and gasoline spreads and, the gasoline story being quite bullish, but at the same time, component prices pretty much going down, which is quite an anomaly. The more the gas naphtha is wide, the more you want to start using Reformate, the more obviously Reformate prices are supported. And we did not see that this year. What can you tell us about the why and, obviously talk about other aspects of the gasoline market right now, but I wanted to emphasize on that.
Okay. Yeah, let's just start looking at historical values of different prices. In Reformate, I think is the most clear example. If you look at the historical levels, seasonal levels, in 2022, we were at this point of the year, we were at $200 per metric ton versus CBOB. Right now, we are in 38. We have seen some upside during the last week, like $6 per metric ton. It makes sense because the E10 blending margin has been very open in Europe. Right now, that's not the case. But I think one of the main concerns right now in the gasoline market, something that we are receiving out of questions, we are talking with traders, brokers, and so on, is if we will see a very bullish summer. Given that the prices right now are very low for components and gas nap compared to the previous years, will we see a very big rally on the peak of the summer driving season during July and August? And I think we can break down all the different reasons that there are in the market to have these lower levels compared to the previous years. And the first one, looking at the long-term story, all this big escalation for heavy components and aromatics started in 2022 with the sanctions on Russia. This changed totally the market, and we have seen outliers during the last 3-4 years. And year by year, step by step, we are seeing like this impact is a little bit evaporating from the market. So we are seeing lower and lower levels, and the market is finding a new equilibrium where Reformate doesn't need to be at $200 per metric ton. That would be the long-term story, but we have many fundamentals that have impacted this year. So the first one, and the most clear, is Dangote. It's the first summer that we have the new FCC of Dangote running. So that means less demand from West Africa is needed from ARA. So that would be one of the points. The second one is the regulation that we saw last August in 2024 from Belgium, forbidding the sour gasoline cargos with the high sulfur. So that also harms the trading gasoline to West Africa. Then we have another detail about the Dangote market. It has switched from a mass basis to a volumetric one, and this impacts in the heavy component. So right now it's harder to fill a barrel with heavy components and send it to West Africa because you're going to get less money than before this regulation, than last summer. And as you said, another one is gas nap. With levels of 200 gas nap, it's very easy to include components, heavy components into the mix, because naphtha is so cheap that you have this place to complete it with heavy components. And right now, I think that all of these factors, and the main ones comes from West Africa, are the ones that are limiting this upside potential on components and on gas nap. And I think that the medium-term vision could be that we are not expecting such a strong levels last during the previous years. And also, the E10 blend margin right now is closing in Europe. Well, it's marginally open close 45, open 40.10. But yeah, the incentive to blend these components locally has disappeared compared to the previous week.
Interesting. I mean, well, I'm conscious of time, and I'll just explore this quickly. But from what I'm hearing, obviously this impact of volumetric is quite important. Meaning the WAF, for those who are new to this, is obviously WAF was an as-is market, so it was buying in weight, and obviously you are therefore incentivized, or you don't have a negative impact of blending Reformate because you're buying it in weight and you're selling it in weight. Whereas when you blend it into volume markets, you are losing money, and vice versa with naphtha. So you buy it in weight, but you sell it in volume, so you make more money. So obviously that removes a little bit of demand for Reformate, plus the fact that you have Dangote, plus the fact that it's more and more blending is done in the Med. And then you end up in a situation where Reformate, there's just an oversupply of Reformate in ARA, which seems, from what you're saying, to be more of a systematic kind of situation, structural situation. Now, if you accumulate and you start accumulating Reformate, at some point you will necessarily put a cap to the market, in terms of spreads, etc. You will just have an overhang. So that's something to keep an eye on, because at the end of the day, Reformate is how you build gasoline. You need to have, that's the main sort of octane contributor. So it sort of puts a long-term cap on the gasoline market ultimately. So anyone that is massively bullish, structurally speaking, should keep this in mind, because it affects, at the end of the day, it affects both the whole entire, not just ARA, but also it has a ripple effect on the Atlantic Basin, Gulf Coast. Any kind of rally could be capped with this kind of Reformates that will flow either directly or through a blended material. But ultimately, it's also quite interesting for naphtha, because you can now blend more naphtha, whether it's coming from ARA or not. But yeah.
And in naphtha, it's been felt in C5. C5 premiums are quite strong.
Yeah,
right now.
Fair enough. East-West rebounded last week. We spoke as well a little bit about Singapore being excluded, and first initial reaction is the market sort of came off because you could not blend in Singapore to go to Indonesia, which is one of the major outlets. We had that famous tender. We don't know yet the results of it. June, do we have any news on that? No, not really.
Not official result yet, but in the meantime, there was another tender issued for MoGas for RON 98, and that didn't exclude Singapore as the country of origin. Additionally, also for a jet side, there was another Pertamina tender, also not excluding Singapore as origin. So the narrative likely we will see is as what we mentioned, is unlikely to eliminate Singapore as a source of supply.
Yeah, but tell Jorge, you want to add anything on Singapore? What are you seeing?
Yeah, I think right now there is a lot of uncertainty about this, because last week I think it was clear that for second half of the year Singapore was going to be forbidden as origin into Indonesia. Right now it's less clear. I mean, I think that the story is that it's going to keep forbidden, but these last two tenders adds a little bit of speculation about that. But it makes sense with the movements of East-West. We have more factors that we are going to see now, but from this Indonesian tenders perspective, it makes sense the drop of last week and the spike of this one.
And then just following up on gasoline to cover completely on the US side, Arb arbitrage, what are you seeing in the US and the Atlantic?
Yeah, we have a big headline from the Atlantic Basin this week, because we've been talking for weeks that the Arb was open, not just for refiner, but for blenders also, from ARA into Path 1. And right now we have seen a very big drop in the margin. Right now it's closed for blenders. It has been closed 2 days ago, 3 cents per gallon, which is a big drop. And I think it makes sense with the big drop that we have seen, with the drop we have seen in gas nap in Europe. It makes less economic to blend these cargoes, and also with the runs and stocks behavior in the US. If you look at the runs, the crude intake is above the last 5 years. The stocks in gasoline are around the average, and they are above the average in Path 3. Path 5, it's a little bit lower, but it's recovering step by step. So I think that this drop in the margin of Arb match with the fundamentals. Like, there is no need for a very big volume from Europe in the short term, and we are seeing it in cracks and spreads of Arb as well, and on TAR.
So what's the deal here? What's the trade? I'm going to put you on the spot.
I think on EBOB, I see less potential to the upside than before. It has been trading sideways, but right now, with the arc close from 2.1, I think, it can be like a stack into our range for the next week.
Yeah, because when you look at the curve, it was pretty strong backwardation, $8-9 a monthly basis. And correct me if I'm wrong, but as we start that next month, then it sort of does not materialize. That sort of bullishness that people in the anticipation of a bullishness does not materialize, and the pricing during the month has not been exceptional, right?
Yeah, exactly, yeah. And I think that all the conversation I talk with traders and people from the market rely on the previous years, because the previous years what we have seen is a beginning of the summer kind of normal or a little bit strong, but then a big jump in components and in EBOB during July and August. So I think that the people is looking at that and is concerned, like, is this going to happen again? Are we going to see gas snap up $200 per metric ton in July? So with all the fundamentals that we have shown during this podcast, I think that there are less reasons to think about such a bullish summer.
Very well. Okay, well, we're going to stop here for today, and we'll pick up next week probably with distillates and fuel oil, as we haven't talked too much about that. But I think it was a great discussion. I'm very keen to follow up what's going on with crude. It's fascinating to hear what you were saying, John. Keep an eye on those wildfires in Canada as well as an indicator, and similarly to the hurricanes for gasoline. And thanks a lot for everyone to join us. Thanks for all the listeners, because we've really grown in terms of our audience, and it's great to a lot of people at MPGC etc. telling us that they really love the podcast, and some people actually complaining, we don't talk enough about this topic or that topic. They're engaged, and so thanks guys. Any kind of comments or questions, or if you want to hear more about one product, if you want to hear more about one particular person, if you want me to shut up, you can please send comments and we will execute. So thanks again, and thank you guys. I'll see you guys next week.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.